So here we have understood that any of these three factors can contribute to the change in the profitability, which in turn can change the return on equity. So it can be tax factor, or it can be interest factor, or it can be operating profits. And tax factor, and one thing here we should be very careful is tax factor and interest factor can contribute to the change in profitability, decline or increase, but the influence of tax factor and interest factor might not be that huge. But among these three factors, operating profits plays a very significant role in impacting or influencing the profitability. So a small change in profitability, operating profits, can influence a big change in profitability, which can influence a big change in the return on equity. So here what we have tried to do is, we have taken the return on equity, we have decomposed that into profitability, efficiency and risk. And to know what is the real cause for the change in return on equity, we decompose that into profitability, efficiency and risk. And here, with the example, we assume that there was a decline in profitability as well. So we considered that there is the decline in profitability has resulted in decline in return on equity. But here we further wants to know what is that thing which has actually declined. What is the real reason for decline in profitability? So for that, what we have done is we have further decomposed the profitability into these three elements. One is tax factor, interest factor and operating factors. How do we know each of them is this formula we have decomposed as PAT by PBT, where we are trying to know what the influence of tax on the profitability. And by studying the PBT in relation to PBIT, we are studying the interest factor in relation to the profitability, impact of the interest factor on the profitability, which in turn can result in the change in the return on equity and also the operating profits. And this operating profit is something which will largely, very significantly influence the change in profitability. So a small change, whether it is 2% or 0.2%, should be taken seriously. And here we know that operating profits can cause a big change in the profitability, which in turn can cause a big change in the return on equity. To know what is the real cause for decline in operating profits, we can further decompose this operating profits so that we will get to know what is the real cause that is impacting your profitability, which in turn is decreasing your return on equity. So for that, we can decompose the operating profits further. How do we decompose? So before that, let's try to understand what are operating profits. How do we arrive at operating profits? Operating profits. How we get operating profits is, I think we have discussed when we were trying to pick the certain information from the income statement for our analysis, to ease our analysis. So in that I have already given. How we compute operating profits is, out of your revenues, we are going to deduct the cost of goods sold, and we also deduct cash operating expenses, cash operating expenses, deduct depreciation and amortization. So when you deduct these things from your revenue, you get the operating profits. We have already discussed about this. And so this is how we get the operating profits. So any change in operating profits is because of any of this, because of the change in cost of goods sold or depreciation and amortization, operating expenses. This can actually impact the operating profits. So how we calculate based on this formula is, profits before interest and taxes divided by revenue will give you operating profits. And we know that what is the composition of operating profits. So we will get to know what are the elements or the factors which will influence or which will impact the increase or the decrease in the operating profits. Okay, and think that in the previous year the operating profits were 20%. Okay, and in the current year the operating profits is 18%. So we know that there is a decline in the operating profits. So why there was a decline in operating profits? What has caused to the decline in operating profits? Is it cost of goods sold or is it operating expenses? So that we will have to know. So for that what we do is first we will so here we have tried to decompose we are trying to decompose the profitability, that is the operating profits. And we know that the operating profits can be influenced by cost of goods sold, or it can be influenced by your operating expenses. Operating expenses. So we tried to study what is the influence of your cost of goods sold in respect to revenues, and also operating expenses in relation to revenues. So think that previous year the cost of goods sold was 20. The cost of goods sold in relation to revenue was 25%. No, 80%. Yeah. So I think that it was 80. Okay, 20% or 20%. No, this was your operating profits. Your cost of goods sold, think that in the previous year, cost of goods sold as against revenue was 14%. This time it is 17%. So what do we understand by this? By this is there is an increase in the cost compared to the revenues. So your cost of goods sold has increased. In the previous year, for every $100, your cost of goods sold was $14. But this year, for every $100, your cost of goods sold is $17. So there is an increase in cost. So by knowing this, we will get to know that maybe this has contributed to all of this. So since there is a increase in the cost of goods sold, since there is an increase in the cost, maybe this has influenced your decrease in the operating profits. And further, your decrease in the operating profits might have influenced or decreased your profitability, and the decrease in profitability has influenced your decrease in the return on equity. So this is how we decompose each of the element to know the exact reason what is influencing your return on equity. So here with this process, you can easily get to know what has influenced. So decrease in cost has increase in cost has decreased your profits, operating profits, and decrease in operating profits has decreased your profitability, and decrease in your profitability has reduced your return on equity. So this is how we try to relate each other and know the root cause. And here, why the cost of the next question that arises in our mind is why the cost of goods sold has reduced. Why the cost of goods sold has reduced? It can be reduced because of material, because of material cost. It can be because of material cost, or it can be because of labor cost, or it can be because of factory expenses. Factory expenses or factory overheads. Okay, so we now next step is that we will try to learn the relationship between material cost and the revenues. How your material cost has influenced your revenues. Revenue, labor cost divided by revenue, and the factory expenses divided by revenue. Okay, so here we'll get to know whether the material cost has whether the material cost has influenced your increase in the cost of goods sold, or labor cost, or factory expenses. Okay. Now, coming to material cost, see why there might be increase in material cost. Material cost might have increased because there might be increase in the cost, or because there might be increase in the price of the material procured, or maybe inadequate material was available, or there was no proper management of material, mismanagement of material. So any of these reasons might have caused an increase in the material cost, which can increase your cost of goods sold. In turn, that decreases your operating profits, and decrease in operating profits decreases your profitability, which in turn decreases your return on equity. Okay, so what are the causes for decrease in material cost? I said it can be because of price, it can be because of cost, or it can be because of usage. How do you find? To find the actual cost for change in the material cost, we apply one concept called as variances. So material variances. So through material variances, think that in the previous year it was 15% and this year it is 18%. So there is an increase in material cost. Why there is an increase in material cost? I told it can be because of cost, price, or because of the usage. And to find out what is the exact specific reason for the increase in material cost, we are going to apply material variances. So when you apply material variances, you'll get to know the specific reason why there was increase in material cost, which has increased your cost of goods sold, and thereby decreased your cost of operating profits, which in turn has decreased your profitability and thereby decreased your return on equity. So by applying material variances, you'll get to know the real cause or the specific cause for the increase in the material cost. Okay. Similarly, we will also see the labor cost. Again, labor cost, if there is an increase in labor cost, it may be because due to the increase in the labor rate, wage rate, or maybe not no proper utilization of the labor in the uh, factory or the firm, or maybe because there is inadequate labor. Because of all these things, there might be increase in labor cost, and to know the exact reason, we apply labor variances. Similarly, even in case of factory overheads or factory expenses, we apply factory overhead variances. Okay, so with this we will get to know what is the real cause that has contributed to the change in cost of goods sold. The change can be increase or decrease, and the specific reason for the cause of change in cost of goods sold we can easily identify with the help of variances. So with variances we'll get to know the real cause which is contributing to the return on equity. So here we can easily get to know that this return on equity, when you calculate, this is composed of lot of factors. Almost your return on equity covers all the factors that are there in P&L account and balance sheet. So overall, your return on equity covers most of the entire thing of your financial statement. That's why we call return on equity or DuPont model as the best model in understanding the financial health of any firm for that matter. Now let's look into the another factor which is contributing to the which may influence the operating profit, that is your operating expenses. So what are your operating expenses? It can be office and administration overhead, administration overhead. Okay, overheads. This we will study in relation to the revenue. Similarly, then we have selling and distribution overheads. Selling and distribution overheads divided by revenue. Again, here even these overheads can also contribute to the increase in these overheads can contribute to the decrease in the operating profits. So we try to study this, and to know the exact reason why there is a increase in office and administration overhead or selling and distribution overhead. Again, we apply overhead variances. So we'll get to know the exact specific reason what has contributed to the decline in the operating profits, and in turn decline in the profitability and decline in the return on equity. Or if there is an increase also, we'll get to know what is the exact cause that has contributed to the improvement in the return on equity. So by decomposing each and every item, almost we are covering all the ratios, we are covering all the elements to find out the ROE, return on equity. So this is how it helps us. So we have understood that as per DuPont model, one parameter, that is return on equity, is sufficient enough to know in which direction the firm is moving. Whether it is moving in the right direction or not, we'll get to know. And we'll get to know what is the reason or what is the factor that has contributed for that direction. And for that, we know that we decompose the return on equity as profitability, efficiency, and risk. And profitability is further decomposed into tax factor, interest factor, and operating profits. And operating profits is further decomposed into cost of goods sold against revenues and operating expenses against revenue, to know the exact reason why there was an increase in cost and which has contributed to the decrease in the profits and the profitability and the return on equity. So we know that the factors that contribute to the return on equity are the profitability, efficiency, and risk. We know how to decompose the profitability. Now let's learn about the efficiency. The second component which can have an influence on return on equity is your efficiency. Efficiency of what? Here, as per DuPont model, efficiency is of the resources in the organization. How efficiently the resources are utilized. So that how is efficiency calculated? Your revenues divided by total assets. So here, what we understand by this is how much of the revenues you are able to generate, or the firm is able to generate out of the total assets it has. So for example, think that in the previous year, the revenue by total assets or the efficiency is 10, and this year it is 8. So what do we understand by that? We understand that in the previous year, for every 1 rupee of total assets, the firm was able to generate 10 rupees of revenues. But this year it was able to generate only 8 rupees. So that is, there is a decline in the revenues. That is, there is a decline in the efficiency of the total assets. So now we have got to know that there is a decline in the efficiency, and this may have contributed to the decline in the return on equity. But now we are more interested in knowing which asset has caused for this decline, which asset is used inefficiently. For that, and the information for finding this, it's readily available in the annual report. So for that, we further decompose this. We know that total assets are made up of current assets and non-current assets. And non-current assets, we know they are the fixed assets. Current assets, they are the working capital assets. So when we further decompose, we take revenues by fixed assets. Fixed assets. Okay. So last year, the revenues generated in comparison with fixed asset was 11. This year it was 10. So there is a reduction. And here one thing we'll have to be little careful is that if there is a change in this because of fixed assets, if there is a change, when you compare the revenues with the fixed asset, if there is a decline or increase, don't take it seriously, because your revenues most of the time are not directly connected with the fixed assets. For that, I'll give you an example. Think that 2 years because of the pandemic, because of the COVID, there was a decline in the demand. People were not demanding for the product. So that reason has caused for the decline in the revenues. So at that time, can you blame the total assets for the decline in the revenues? Not at all. So your total asset has not contributed to the decline in the revenue. Okay, take one more instance. Think that on a normal situation, in a normal condition, there was non-availability of raw materials, or there might be inadequate availability of raw materials. Because of inadequate availability of raw materials, your revenues have declined. And here also we cannot blame fixed assets. So when we are decomposing and trying to know the efficiency of the assets, your revenues to fixed assets ratios you can calculate and keep, but don't take it seriously for interpreting the financial health of the firm. That is because your fixed assets most of the cases does not directly contribute to the revenue. Okay, and the next one, when we decompose further, we try to compare or study the revenues in comparison with your current assets. But here, as we all know, current assets are very much directly connected to the revenues. A small change in current assets can lead to a big change in revenue. It can be negative change or it can be positive change that can influence the efficiency, in turn can influence the return on equity. So here think that this ratio is 11 previous year and this time it is 10. So there is a 1 rupee decline or $1 decline compared to the previous year. So this here, though there is a very small decline or a small difference or a small decline compared to the previous year, this has to be taken very seriously by the firm, by the business. They should not ignore. See, in case of fixed assets, you just keep it aside, don't take it seriously for decision making. But in case of current asset, even a small change, even a small decrease should be taken very seriously, because a small change in this can end up in bankruptcy, can end up in closing or shutting down the business. So this has to be taken by in current assets. Why there was a decrease in efficiency? One, it can be inventory turnover ratio. One, it can be because of inventory. So let's look into that. Inventory. Inventory. So to understand the contribution of inventory, we refer to inventory turnover ratio. We all know how we compute the inventory turnover ratio. So when we know that current assets or working capital can cause a big concern. So a small change in working capital management can lead to a big change. A small change in current assets management or working capital management can lead to a big change or a significant change. So if the current working capital is not managed properly, efficiently and effectively by any organization, it can take that firm to the bankruptcy position. So any small change in management of working capital should be is of a serious concern and it should be paid with high attention. Okay, so here the current assets, especially here we take into consideration inventory turnover ratio and receivables turnover ratio. Receivables. So these two should be managed properly in order to manage your current assets properly. So think that in inventory turnover ratio, in the last year it was 6, this year it is 4. So what do we understand by that? So 6 times there was a turnover of inventory. That means the inventory stayed with the company for 2 months. So every 2 months there was a change or there was a replacement of the inventory. That was inventory was moving. So there was no blockage of inventory. Okay. But compared to the last year, this year it is 4. That means every 3 months, it took 3 months for you to recycle that inventory. In the last year it was 2 months. Now it is 3 months inventory movement. So the number of days, 1 month extra, it is getting blocked. It is staying in the firm. So there is a this is a cause of concern. So the movement of inventory is very less compared to the last year. Because of this movement of inventory is less, there is mismanagement in the current working capital or the current assets, which has contributed to the inefficiency of the assets in with respect to the revenues and then in the return on equity. Then coming to receivables turnover, think that receivables turnover was 6 and 4 again. So what do we understand by receivables turnover 6 for the previous year is that 6 means that is the credit period given by the firm to the customers was 2 months. So every 6 months there was an inflow. So 2 months credit was given in the previous year. This year 3 months credit was given. That is your money, the firm's money was blocked with the customers for 2 months in the previous year. But for the current year, it is getting blocked for 3 months. So it is a cause of concern. So if small mismanagement of these two can lead to a big mismanagement of current assets or the working capital, which in turn can close up the business itself. So this is of a serious concern. This has to be taken very seriously to understand which is the asset which is not managed properly, and accordingly take up proper steps in order to manage them. So what we try to do it now is we try to out of the three elements in analyzing the return on equity, we have decomposed receivables. We have tried to see how fixed assets will affect your revenues and current assets. And fixed assets we don't take that seriously because it is not directly connected with the generation of revenues. But whereas current assets every day, every time directly is connected to the revenues. Proper management of current assets can make a company to grow faster at a higher rate, but whereas mismanagement, improper utilization of the current assets can close down the business form. And inventory, there we consider inventory turnover ratio and receivables turnover ratio. Proper management of inventory and receivables can lead to proper management of current assets. So by managing the current assets properly or the working capital properly, the firm can increase or better the efficiency of the organization. But if this is not managed, the efficiency falls down, which influences or impacts your return on equity, which will also decrease or lead to a decline in your return on equity. So as I told you in the beginning, not only profitability, even the efficiency can also contribute to the change in the return on equity, whether it can be increased or whether it can be decreased. So here we have tried to decompose the efficiency which can contribute to the return on equity. The exact reason whether current assets have contributed. In current assets, what is that has contributed to the decline in return on equity? Is it because of inventory or is it because of receivables? See here, looking at this, money is blocked in the current year more in inventory and receivables compared to the previous year. And this blockage of money has led to mismanagement of current assets, so which has contributed to the decrease in efficiency. Because there was decrease in efficiency, this efficiency has also become one of the reasons for the decrease in return on equity. So this is how we interpret and know where the firm is moving, which direction the firm is heading to, and analyze. Based on this, analyze the financial performance. Then after this, we will look into the third factor contributing to the return on equity, that is the risk. Now let's look into the third element or third factor contributing to the increase or decrease in the return on equity, that is a risk. Here, risk, what risk we are talking about? Basically, we are talking about the financial risk. Financial risk. So, what is financial risk all about? So, a firm will have financial risk when there is a borrowing. When the firm borrows, it is exposed to financial risk. Is it good to borrow? Is it not good to borrow? And what are the consequences of borrowing funds? See, for example, when the firm has debt capital or loans, we know that when the firm makes profits, earns or generate profits or not, it will have to make the interest payments. Irrespective of the profitability, they will have to make the payments. If they don't make the payments, then the debt holders or the lenders of the money to the firm can take over the asset. And in turn, in the end, they might also, it might lead to the close down of the business. So financial risk will tell us what is the composition of the loans or the borrowed funds in the total capital structure of the company, how it impacts the return on equity. So that we will see how your financial, is it good to have borrowings along with equity share capital, or is it not good to have? That we will see whether the firm should take risk or not. And we know that when you take little risk, it also end up in having more profitability. But taking that risk, if it crosses a particular limit, might lead to a very damaging to might cause damage to the entire organization. So when financial risk arises, when there are borrowings in the company, and when there are borrowings in the company, the firm has to regularly pay the interest payments and also fulfill all the obligations of the debt holders. If in case the firm is unable to pay the interest payments on time, then the debt holders can take over the assets of the firm. When the assets are taken over, obviously it will lead to the dissolution of the business firm. So proper management of risk can add on the advantage to the firm, whereas mismanagement of this financial risk can lead to liquidation or winding up of the company. And having debt or borrowed funds, is it good or not? Let's have a look at it. To know whether it's advisable for the firm to have borrowed funds in the capital structure of any firm, let's take one example. Think that you want to start a business and you require an investment of 20 lakhs. Okay. And you, through market survey and market research, you get to know that the return on investment of from this business might be 20%. So what do we understand by return on investment? Your return on investment is nothing but your EBIT rate, because this is the return which you can expect on the total investment made in this firm. So going by this, your ROI is nothing but your EBIT, earnings before interest and taxes. So because out of this earnings only, you'll be making payments of other expenses, obligations like your interest and taxes. And if in case you have preferred capital, preferred dividend also, you might pay. So your EBIT would be earnings before interest and taxes will be 20%. So 20% of the investments you have made. So it comes up to 4 lakhs. It comes up to 4 lakhs. So you can expect when you can expect an ROI of 20%, you can expect a EBIT of 4 lakh when you have made an investment of 20 lakhs. So this is about the new business you want to start. But the next question is, how are you going to get this investment? This 20 lakhs, how are you going to get this investment? There are a lot of ways, there are a lot of sources which you can tap for getting the investments. So let's take two options, option 1 and option 2. In option 1, you would decide to raise this 20 lakhs out of equity. So entire 20 lakhs will be your equity capital in case of first option. In case of second option, you would want to raise this 20 lakhs by issuing equity shares, preference shares, and also debt. So that we will see how much you can, it depends on how much you want to raise. So now we'll take an hypothetical example. First option, you would like to raise the entire 20 lakhs with the help of equity share capital. In second option, you think that you want to raise it through 4 lakh through equity share capital, 6 lakh through preferred share capital, and 10 lakhs through debt capital. Okay. So this is these two options are available for you for raising the investment that you require for your new funds. With this, let's see what happens. First, out of we know that whether you go for this option or this option, your investment would be 20 lakhs and your return on equity on this is 20%. So your EBIT is 4 lakhs. Your EBIT is 4 lakhs. Okay. See, in case of first, you don't have any debenture capital, so you don't have to pay any interest. But in case of second one, since you have a debenture capital, you need to pay the interest. And what is the rate of interest in case of debt capital? 12%. 12% on 10 lakhs, which comes up to 1,20,000. So from EBIT, first you will deduct the interest payment. So you get a EBT of 4 lakh if in case you're going for option 1. If in case you're going for option 2, you'll get 2,80,000. Out of 4 lakhs, 1,20,000 you're paying as interest payments for the debt debenture capital. But whereas in case of option 1, you don't have to pay. So your EBT after paying interest in option 1 would be 4 lakh, option 2 would be 2,80,000. Then after you make the interest payment from the profit, the next obligation you will have to fulfill is your taxes. You will have to make the tax payment. Think that 30% is the tax rate. And this tax rate is always paid out of EBT. Okay, on EBT that tax rate is levied. So 30% on 4 lakh comes up to 1,20,000 and 30% on 2,80,000 comes to 84,000. See here, one thing you can observe. You end up paying higher taxes when you don't have a debt capital, but you pay lesser taxes when you have a debt capital. This is the advantage a firm gets when the firm has a debt capital or a borrowed funds. See, borrowed funds offer the tax advantage to the firm because you end up paying lesser taxes because you get the tax advantages on the interest payment you pay to the debenture holders. So let's see what is earnings after taxes. So your earnings after taxes in case of option 1 would be 2,80,000. In case of option 2 would be 1,96,000. And here we know that in the option 2 there are preferred share capital. So in the first case you don't have to pay preferred dividends. So the first thing we make the payment is we pay to the debenture holders. After we pay to debenture holders, we pay to the tax authorities. After that only preferred shareholders would be paid. So in the first option, since there is only equity share capital, you don't have to pay the preference dividend. But in case of second, it is 16% on 6 lakh. So 16% on 6 lakh comes up to 96,000 is the preferred dividend you're going to pay. Then the net income which is available would be 2,80,000 in the first case and 1 lakh in the second case. And this is the net income that is available to the equity shareholders. So now we have net income we have calculated in case of both the options. Let's see how what would be the return on equity, ROE. We know how we calculate the ROE. ROE is equal to profit after taxes. We usually take profit after taxes if there is no preferred preferred share capital. But since here we have preferred share capital, we are going to take net income. So net income divided by equity share capital. Equity shareholders funds. So 2,80,000 divided by 20 lakh. For the second option, it is 10 lakh divided by 4 lakh. So we get 14% as the return on equity in case of first option. In case of second option, 25%. So this clearly tells us that using borrowed funds along with the equity share can increase the ROE. By taking financial risk, there might be higher returns. Again, there are a lot of factors contributing to that. So here, the answer to our question, should we have debt or not? Yes, we should have debt we should have borrowed funds, which gives the tax advantage and also which helps in improving the ROE. But again, there are a lot of other factors when you're having the debt capital in the capital structure along with your equity. So here we have understood, or we have seen with an example, that when you have borrowed funds, your ROE increases. So when you have borrowed funds, it means that there is an increase in financial risk. So here we have seen how profitability influences ROE, efficiency, how it influences ROE. Now, increase in risk will increase in ROE, return on equity. Just now we have seen. Here, risk means financial risk. So, when does the financial risk arises? When there are borrowings with the firm. So, when the firm has borrowings, there is increase in risk. When there is increase in risk, there is increase in return on equity. So here we have learned how to compute or measure profitability, how to measure efficiency. Now let's learn how to measure the risk. And we know that risk is connected to financial risk, and financial risk increases, or there is financial risk when there is borrowed funds. When there is borrowed funds, your ROE also increases. And how do we measure risk? For this, we use the proprietary ratio, that is total assets total assets divided by equity shareholders funds. This is a proprietary ratio, and this proprietary ratio we use for measuring the risk. Okay, and this proprietary ratio tells us that how much of the total asset is being funded by the equity shareholders. Okay, so here we have learned that return on equity is because of profitability, efficiency, or risk. Higher the return on equity. Lower the three of these, lower is the return on equity. And see, I want to show you once again here. We had decomposed return on equity into profitability, efficiency, and risk. So when you multiply profitability into efficiency into risk, you will get return on equity. PAT divided by revenues divided by total assets, and total assets divided by equity shareholders funds. So when you multiply these three, profitability, efficiency, and risk, see this revenues, denominator revenue and here numerator revenue gets cancelled. Then denominator total assets and numerator total assets gets cancelled. So in the end, when you multiply, what you are left with is PAT divided by equity shareholders funds. That is nothing but a return on equity. So PAT divided by equity shareholders funds. So that's right. See, now I think you all have you all have witnessed, you all have visualized how return on equity covers the entire annual the statements in the annual report. It takes into account each and every item, every element from the P&L account and also from the balance sheet. So this one ratio covers the entire financial statement of any organization. That's why with this one ratio, it's fair enough for us to predict or know in which direction the firm is moving, whether it is moving in the right direction or whether it is not moving in the right direction. And if in case it is moving in whatever direction it is moving in, what is the reason? What is the cause for that direction? That also we will get to know by decomposing the ROE with the help of DuPont model. I think now after learning how to apply DuPont model and how it influences or how it contributes in analyzing the financial health of any company, I think all of you can appreciate the contribution of Donaldson Brown in giving us this DuPont model, which is almost used by everybody till today. It is used, and it is a 100-year-old model. It is older than all of us. So I think I want you all to try this with any annual report you pick up. Try applying this DuPont model. You should be in a position to analyze the financial health or the condition of any organization. Thank you all.